So we looked at the profile of the company, we compared the financial ratios with the peer group. Now it's time to trade-off theory, and here I will show you the framework for practical application of trade-off analysis for this mature company. Okay, value of levered firm is the sum of present value of unlevered firm, present value of interest tax shield, present value of incentive benefits of debt, and minus present value of costs of financial distress. So as the debt level increases, the firm benefits from the tax shield and improved incentives for management. However, if the debt level is too large, firm value is reduced due to the costs of financial distress. Let's start the analysis with tax benefits of debt. So which type of firms would we expect to have particularly higher tax benefits? And the first type of this firm is firms with higher profits. So if profits are high, that means that more taxes are paid. That means that interest can shield more income from taxes, and that gives us higher tax benefits. With our company, it has high EBITDA and EBIT margins, therefore more taxes are paid, and that gives us higher tax shield and higher tax benefit. The second type is the firm with less volatile profits. So if profits are less volatile, that means that there is a lower probability that profits are less than interest payments. And for our company is a mature firm. That means that we have lower volatility of profits and therefore higher tax benefits. We are the large firm within the industry, so that means that we have more economy of scale, and that means lower operational leverage, lower volatility of profits, and again, higher tax benefits. Our industry is not cyclical, so again, that means that we have lower volatility of profits and higher tax benefits. So our conclusion is that tax benefits of debt are high. The next, incentive benefits of debt. You know that managers make wasteful spendings when firms have cash flow in excess of what is needed. When cash is tight, managers have to run the firm as efficiently as possible. Firms with debts have to make interest payments and have to repay these debts. So that repayments reduce excess cash flows, and that means that it reduces wasteful spendings by managers, and that gives increasing firm value. So which firms are likely to have high incentive benefits of debt? It's mature, moderate growth, cash-rich companies or industries. And for our company, we have high EBITDA and net income margin. That means that managers can make wasteful spendings, and therefore we have high incentive benefits of debt. So our firm has small investment needs. It is a mature company, and therefore we have higher cash flows, and managers can make wasteful spendings. Again, that gives high incentive benefits of debt. Another type of the firm is larger firm within the industry. So again, larger firm, more economy of scale, that gives lower operational leverage and lower volatility of profits. With that, we have relaxed management who can make wasteful spendings, and that gives us high incentive benefits of debt. So our conclusion for this company is that it has high incentive benefits of debt. The next, expected costs of financial distress. And if we talk about expected costs, we have to take into account probability of financial distress and cost if the company is in distress. Let's start with probability of financial distress. And which firms are likely to have high probability? It's firms with high competition risk, firms in unproven markets with high demand volatility. It's startup companies with unproven business model. It's firms in technology sector with high research and development dependence, and it's firm with large cyclical or seasonal variations, and smaller firms without diversity across businesses and products. And we see that none of the above applies to the company. Our company is large in non-cyclical industry. It is mature business with proven business model, one of the leaders in the industry. So our conclusion, probability of financial distress is low. Which firms are likely to have high costs of financial distress? The first type is firms with valuable relationships with customers, suppliers, and employees. For example, durable goods producers. If the car manufacturer is in financial distress, customers are less willingly to buy its automobiles because they don't want to face with the situation that they bought the automobile and there is no service after the distress of the company. So that leads to revenues, to decreased revenues. And suppliers of this kind of automobile producers, they demand prepayments. They don't want to deal with the company in financial distress. And that leads to cash deficits. Another example, human capital intensive companies. For example, a bank in financial distress. Employees of this bank leave and they want to work in a stable bank. And bank has to pay higher salaries to return these types of employees. The second type of the firm is a firm in highly competitive environment. So this firm have to preserve high margin in order to service debts, to pay interest on debt, to repay debt itself. So if competitors cut prices, they cannot respond. And with higher prices, they cannot decrease their prices as well. And with higher prices, the firm loses the market share and eventually the revenue. And another type is smaller firms, and because many aspects of the bankruptcy process are independent of the size of the firm, the costs are typically higher in percentage terms for smaller companies. Another type, firms with difficulties to sell assets in distress. It's like research and development intensive industries with intangible assets, because it's easier to sell office or a car rather than intangible assets. The second is specific or highly specialized asset, and this asset has only few potential buyers, like highly specialized metal press. And with few potential buyers, you have to provide higher discounts for fire sale. And it's cyclical industries. When a firm in distress due to some downturn in the economy, other companies in this industry are also in distress. And for example, airline. The economy goes down, the particular company is in distress, it wants to sell airplanes, but all the potential buyers are also experience difficulties and they don't want to buy these planes. And the last type, firms with high investment needs. It's capital-intensive firms or firms with high marketing expenditures. So underinvestment is costly. And if you don't have cash for capital expenditures, you would not be able to expand as you planned and you will lose your market share. So again, if we look at our company, none of the above applies to it. That means that costs of financial distress are low. And with low probability of financial distress, the expected costs of financial distress are also low. So, conclusions. With high benefits of debt, high incentive benefits, high tax benefits of debt, high incentive benefits of debt, low probability of financial distress, and low cost of financial distress, the company should increase its leverage. And we also see that median debt to capital ratio for peers is 54. And the company has a lot of room with its leverage of 0. And we also see that the company is one of the leaders with highest margins. It's like 28% EBITDA versus median of 17% across the peer universe. So the company can have even higher leverage than peer companies. Our company is over liquid, it has excess cash, and under levered, it has 0 debt. So its shareholders are paying price for that. And in order to unlock value inherent to the company, we can use cash on its balance sheet and borrow money to buy back its shares.